Welcome to vTalkInsight, Risk Sentiment Daily for April 15th, 2026. Equities are back at or near record highs, even as the Middle East energy shock deepens and yield curves keep steepening. Today we unpack why risk appetite remains resilient, what is driving the current chase into growth in AI, and where the underpriced risks are building beneath the surface. Risk sentiment today is firmly risk-on, but with a fragile undercurrent. The S&P 500 has added more than 1%, pushing back to fresh record territory, while equity volatility has drifted lower and the Nasdaq has clocked a double-digit winning streak. That price action matches a broad narrative of resilience. Indices are within a couple of percent of their highs. Previous losses tied to Iran war fears have been fully recovered, and growth and momentum styles are strongly in favor. Under the surface, though, the story is more nuanced. Equity investors appear to be treating the Middle East conflict and shipping disruptions as temporary shocks, focusing instead on robust earnings expectations, AI-driven growth, and hopes for U.S. Iran diplomacy before the April ceasefire deadline. By contrast, fixed income and commodity signals look more cautious, with safe haven demand for sovereign bonds, persistent concern about inflation from energy and input costs, and mounting evidence of a structural energy and supply chain shock. So the backdrop is a resilient risk-on tape that leans heavily on earnings and policy optimism, while several slow-burning macro risks are at risk of being underpriced. Resilient earnings and an AI-led equity rally are the backbone of today's bullish sentiment. Equity markets have not only retraced their conflict-related drawdowns, but are now sitting within about 1 to 2% of all-time highs, helped by expectations of roughly mid to high teens earnings growth into 2026. Recent reports from major U.S. banks, large tech platforms, and industrials all point to solid profit trends, and forward estimates for S&P earnings have risen since early March rather than being cut, despite geopolitical turbulence. The AI and technology story is central here. Tech sector earnings have consistently beaten expectations, with semiconductors and AI-exposed hardware up mid-teens so far this month, and the Nasdaq 100 logging its longest winning streak since 2021. Importantly, market breadth has improved beyond mega-cap names, with gains extending to cyclicals, small caps, U.S. industrials, and energy linked to AI infrastructure and reshoring trends. This combination of broadening participation and strong growth leadership reinforces the perception that corporate fundamentals can absorb higher input costs and geopolitical noise, at least for now. Geopolitical de-escalation hopes easing oil are another powerful support for risk appetite. Equities are pricing in optimism that U.S. Iran talks will restart in venues such as Islamabad or Geneva, and that some form of renewed agreement can be reached before the ceasefire expires on April 21st. Against that backdrop, quoted oil prices have moved lower, even as physical supply remains constrained, and energy equities have given back prior overbought gains as the immediate risk premium comes out of the sector. This easing in perceived geopolitical risk is feeding directly into cyclical assets. Airlines, travel, and growth stocks are rallying alongside broader U.S. indices, helped by the idea that any oil shock will be managed and that energy prices will not derail the soft landing narrative. The flip side is that markets have become highly dependent on continued diplomatic progress. The April 21st ceasefire deadline stands out as a binary checkpoint where disappointment could quickly force a reassessment of both oil pricing and equity risk premia. Strong bank and asset manager earnings add another important leg to the bullish case. J.P. Morgan has reported earnings per share close to $6, with revenue above $50 billion and net income up double digits, while Citi has posted its highest quarterly revenue in a decade on the back of more than $5 billion in fixed income sales and solid equities trading. Goldman Sachs has delivered record equity trading revenue, and across Wall Street, major banks highlight strong trading and advisory activity despite macro uncertainty. On the asset management side, BlackRock has posted exceptional results, underpinned by around $744 billion of net inflows over the past year and robust demand for its ETF and retirement platforms. Recent quarters have also seen more than $100 billion of fresh client cash moving into its products, pointing to persistent appetite for liquid, diversified vehicles amid volatility. Together, healthy bank trading income, resilient credit quality disclosures, and strong inflows into public markets reinforce the idea that the financial system is liquid, functioning, and still willing to fund risk assets. Set against that optimism, the Middle East energy shock and supply chains remain the clearest downside risk. Tanker traffic through the Gulf has collapsed from well over 100 vessels per day to only a handful, as U.S. and Iranian restrictions and a blockade of the Strait of Hormuz disrupt oil transit. Insurance premia for ships attempting to cross have jumped from around 0.25% of cargo value to as high as 5%, and many carriers are simply refusing to provide cover, leaving vessels idling. These disruptions are already rippling through the broader supply chain. Vessel fuel prices have doubled in 6 weeks, freight rates in the region are under heavy pressure, and congestion at key Asian ports such as Singapore, Shanghai, Korea, and Japan is rising, with risks of spillover into trans-Pacific trade. There are also credible concerns that closures could spread to the Red Sea, which would put up to 5 million barrels per day of Saudi exports and major container routes at risk. Even in optimistic scenarios where the conflict ends soon, estimates suggest shipping normalization could take several months, while repairs to damaged energy infrastructure may require years, pointing to a long-lived supply shock. Inflation and higher-for-longer rates risk are the macro channel through which these shocks can hit valuations. Persistent tightness in energy, aluminium, and other industrial inputs is pushing up costs, with physical aluminium premiums in Europe doubling to around $600 per ton and prices for plastics, ethylene, and copper all rising sharply. Gasoline and diesel prices above $4 and $5 per gallon are drawing political scrutiny, and there is a growing view that oil sustainably above $90 would likely spill over into wider inflation, particularly for transport and food. Central banks have limited room to absorb these shocks. Many developed market policymakers are already running relatively loose stances with inflation still above target, raising the risk that a renewed price surge forces more aggressive action or, at minimum, delays rate cuts further. Market expectations for the Federal Reserve have shifted to just one cut this year, with additional easing pushed into 2027, and several officials are leaning toward a wait-and-see approach because of oil and Middle East uncertainty. Yield curves are expected to steepen further, potentially by another 25 to 30 basis points, and spreads in more indebted sovereigns such as France, Belgium, and Italy are seen at risk of widening as funding costs stay elevated. Stretched valuations and fragile earnings breadth round out the key bearish drivers. Equity markets are currently pricing in roughly 14% earnings growth for the S&P 500 in 2026, with some estimates closer to 18% after recent upgrades. Growth stocks have surged 9.5% this month versus around 2.5% for value. Momentum strategies are up double digits, and a narrow group of technology names is carrying much of the index-level performance. That leaves a high bar for positive surprises if margins come under pressure from wages, shipping, and input costs. Under the headline numbers, signs of fragility are emerging. Earnings strength is concentrated in energy and technology, with several other sectors flat or declining, and the Citi and UBS revision indices have turned negative, highlighting growing downside risk to the broader earnings outlook. There are also idiosyncratic warning signals. LVMH has reported a 50% drop in Middle East sales. Wells Fargo has disappointed on net interest income and disclosed sizable private credit exposure, and Goldman Sachs has missed expectations in fixed income trading despite record equity revenues. Together with concerns about private credit transparency and the possibility that recent trading windfalls are not repeatable, this concentration of strength raises the risk that any growth wobble could have an outsized impact on richly valued indices. To sum up, today's backdrop is a resilient risk-on environment powered by AI, strong earnings, and solid results from banks and asset managers, all reinforced by hopes that U.S.-Iran diplomacy will keep oil in check. Against that, a deepening Middle East energy and shipping shock, higher-for-longer rate dynamics, and stretched, narrow equity leadership point to a growing risk that inflation, growth or earnings could at some point force a repricing. Key things to watch from here are the April 21st ceasefire deadline, how quickly supply chain strains spread beyond energy into broader goods prices, and whether upcoming earnings can keep matching the very high bar now embedded in valuations. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.